Hi, my name is Nadia Rodriguez. I'm an active CPA in the state of Texas. And my passion is to share knowledge. And I see this when I explain the tax return to my clients, a Form 1040, which is your federal income tax return. It's a long journey, but you know what? We partnered together and I walked them through this journey. So come along as I walk you through this journey on explaining how the 1040 journey looks like. And don't forget to subscribe and hit that notification button so that you can get notified when we share new videos. You can join the Nadia CPA Insider Club, where I get to share more tax knowledge. And if you're ever interested in learning how to prepare tax returns, make sure you subscribe for my upcoming courses. The Federal Form 1040. That's the individual income tax return that gets filed every year. Now, it's a long form, not only the form itself, but it has schedules, it has attachments. It's a long journey. So let's go on this journey together. We start off with the federal tax return 1040 at the very top. Income. There's specific lines to list your employment income, your W-2 income, your business income, investment income, then other income. That is your total income. The general rule is that we are taxed on all of our income, unless there's a code section that allows for an adjustment for a deduction. But for now, we're going to start off with all of our income. And that is called our gross total income. Then we go across Schedule 1, which is adjustments to that income. Now, if there was not a line that was specifically outlined on the very first top of the 1040, like business income, employment income, you know what? There's no escape because we have Schedule 1 that also has line items for very specific income. An example is gambling income. That gets listed on Schedule 1, and that will increase our gross income. But then we also have on Schedule 1 some adjustments, some reductions to that gross income. An example is educator expenses. If you're a teacher, kinder through 12th, and you spend some money on some supplies for your classroom, there is a deduction for that. So that's an adjustment. The adjustments from gross income arrive to adjusted gross income, or better known as AGI. Now, AGI is a pretty important amount to know because some of the credits, some of the schedules that we can see or forms are subject to a certain limitation of your AGI. So always know what that AGI is. It's important to know, adjusted gross income. But then our next step, the law also allows for some deductions from that AGI, from that adjusted gross income. We have the standard deduction or the itemized deduction. Now, it's either or. You can't do both. What you have to do is you have to compare what the standard deduction amount is, and what is your itemized deduction. Which of the two is greater? And that's the one that you get to take as a deduction. The standard deduction, just like the name says it, it's a standard amount that the government has come up with to determine what your living expenses are based on your filing status. If you're single, you get a different amount than if you're filing as married filing joint. So you take that amount and you compare it to your itemized deductions. What goes in your itemized deduction? There's several amounts that go in there. It could be your medical expenses that are over the amount of 7.5% of your AGI. Remember, we talked about AGI. So 7.5% over AGI, that amount of medical expenses get accounted for as an itemized deduction. So you take your medical expenses above your 7.5% of your AGI, you add your SALT, which is your state and local taxes. That gets added to the amount, up to $10,000. And then you have some mortgage interest that gets included in there too. Charitable contributions, and then other itemized deductions. So you take those two buckets, your standard deduction amount that was given to you by the government, and then you take the itemized deduction, the amounts that you added up together. Compare those two, which one wins? That is the amount that will reduce your adjusted gross income. Then from that amount, we have another deduction, qualified business income deduction, QBI, which is also subject to limitations in itself. But the most important thing is that you need to have a business in order to even look into this QBI deduction. So after we reduce our adjusted gross income by the allowed deductions, we arrive to our taxable income. That is the amount that is used with our tax tables to see how much of our tax is due based on that taxable income. So yes, you brought in a lot of money through your income at the very top of the form, Federal Form 1040, but you go through this journey of some adjustments, some deductions to arrive finally to taxable income. You're not going to see taxable income be the same exact amount as your total income that was reported, what you started with. So now you take your taxable income and you go over to the IRS tax tables. Those are based on the filing status and the amount of money that you have at this point at your taxable income. And you go through those tax tables. Now, our tax system, the way it works for federal purposes, is that think about this like a stair system, different stairs. The very first stair, the very first phase is about $10,000 or $11,000. It all depends on the tax table that we're looking at based on your filing status. If you're single, if you're married filing joint, you have a separate table. So you start off with the very first amount of the threshold. The first X dollars are of your taxable income is subject to a certain percentage. And then you move on to the next step. Do you have more than that amount? You probably do. So you reduce that total taxable income, reduce it by the first 10,000 or 11,000, whatever the tax table says. The next amount is subject a range, maybe from 11,000 up to, let's assume 40,000. That is subject to a different tax rate. And so it goes on until you finally have calculated your entire tax on your taxable income amount. So once you have your tax, that's not how much you're going to pay the government. Not yet. We still have a journey to go through. The next step is we look at other taxes that we're liable for example, the self-employment tax, and then maybe other non-refundable credits that we are allowed. They're called non-refundable credits because whatever this tax amount was, the non-refundable credit is limited to that amount of tax. For example, let's say you owe the government a total tax of $100, but your non-refundable credit that you computed is $500. Well, you know what? You can only use $100 of that credit, and the rest, depending on the law and depending on the credit, it gets carried forward, or maybe you lose it. It all depends on the type of non-refundable credit. But again, it's limited to the amount of tax. That is called a non-refundable credit. So then after you've taken care of your non-refundable credits to reduce that tax, do you still have an amount left over of tax liability? You do? So maybe let's go into our tax liability amount. From there, how are we going to pay the government for that liability? Well, there's several ways. First, have you paid in anything to the government during the year? Maybe you had some withholdings on your W-2. Your employer took some taxes away from your paycheck, some federal income tax withholding, sent them over to the IRS to hold for you to when it comes time for tax time. Or maybe estimated taxes. You have a self-employed business. We are required to send in those quarterly payments throughout the year. But also at this calculation, you've taken care of all those payments that you've sent in advance. And then also any refundable credits. Are there any credits that you qualify that are refundable? Refundable means that that amount of tax liability that we have, we reduce it by the amount of refundable credits. And if there's any credits, any non-refundable credit amount left over, you get a refund. You get that money back because it could be refunded to you. It is a refundable tax credit. So after we've taking care of the payments, any refundable credits, that's when we come to our reconciliation at the end. Did we have a refund due to us, which is the government owes us some money, or did we have a balance due? We owe the government. And that's when you have to write the check, you have to make the payment to the government of that amount due.